In the tech world, few events are as iconic as the dot-com bubble. That strange time when simply adding .com to your company name turned it into an instant unicorn. Fast forward to today, and it seems we're once again facing a tech frenzy, only now with AI and semiconductors in the lead. But could we really be in a bubble again? Or are we just feeling nostalgic? Let's dive into the video. The dot-com boom. When investors were internet's besties, the internet hype of the late 90s was explosive. Between 1995 and 2000, the NASDAQ composite skyrocketed over 500%, reaching an all-time high of 5,048 in March 2000. Companies with catchy .com names attracted investors despite often having no revenue or clear path to profitability. In the height of the frenzy, companies like Pets.com raised millions in IPOs, with Pets.com securing $82.5 million. However, without sustainable income, many companies rapidly burned through their cash reserves and ultimately failed. The year 1999 alone saw more than 500 IPOs, most in the internet sector, marking an era where hype often replaced financial fundamentals. As their losses mounted, these companies could no longer justify their valuations, leading to the bubble bursting as funding dried up. Overconfidence and speculative trading during this period devastated many investors when the bubble inevitably collapsed, signaling the importance of grounding valuations in revenue potential. The hype cycle, from euphoria to reality check. In 2024, the explosive growth of AI stocks is giving investors deja vu of the dot-com bubble, raising questions about the sustainability of such high valuations. For instance, NVIDIA's stock surged by a staggering 252% since 2022, driven by its pivotal role in manufacturing AI-related semiconductors. This explosive growth hasn't been limited to one company. By mid-2024, the AI sector attracted over $100 billion in investments, with much of it funneled into high-profile firms like Google, Microsoft, and emerging AI startups. This boom extends to other industries, with sectors like healthcare and logistics increasingly incorporating AI solutions, fueling further growth. The AI hype has, however, led analysts to draw cautionary parallels to the dot-com bubble, warning that without solid revenue models, these companies could face similar challenges. The dot-com bust illustrated that valuations untethered from fundamentals are unsustainable, a lesson today's investors are reminded of as the AI wave builds momentum. From NASDAQ highs to rock bottoms, the bust. The dot-com bubble left a deep scar on the global economy, providing a cautionary example of speculative overreach. When the bubble burst, the NASDAQ plummeted from its peak of over 5,000 to below 1,200 by 2002. Representing nearly an 80% drop and wiping out around $5 trillion in market value. This collapse was quick and ruthless, with the sharpest decline occurring between March 2000 and March 2001, pushing high-profile firms like Webvan and eToys into bankruptcy. The crash impacted more than just companies. Average investors suffered too, as they watched life savings disappear in speculative tech investments. The bubble burst led to widespread layoffs, with tech-heavy Silicon Valley feeling the brunt, and ushered in a period of stricter financial regulations to prevent future speculative mania. The dot-com crash underscored the dangers of unrestrained market exuberance, leaving a legacy of caution that still echoes in today's tech and AI sectors. Dot-com versus AI boom, how 2024's hype stacks up. Today, AI stocks such as those of Microsoft, Nvidia, and Google have rallied tremendously, driving the NASDAQ composite back into the spotlight. In comparison, the NASDAQ in 2000 reached a price-to-earnings ratio of around 57x, far exceeding traditional metrics for stability. In contrast, today's NASDAQ trades closer to a 27x ratio, which, while elevated, reflects a more measured investor approach. Additionally, today's market leaders in AI have diversified revenue streams, such as cloud computing and subscription models, helping to support their valuations. But analysts caution that many AI companies, particularly startups, are still trading on promise rather than profit, much like their dot-com counterparts. This year, the price of AI and tech stocks has frequently outpaced fundamentals, prompting concerns about whether another speculative bubble is forming. The relative stability of today's NASDAQ may suggest some lessons were learned from 2000, yet there's a growing call for investors to prioritize fundamentals over hype. Lessons from 2000. Don't forget the fundamentals. During the dot-com bubble, companies often launched IPOs with little more than a vision of future profitability. Firms like Webvan and eToys raised millions without viable business models, spending excessively on marketing and infrastructure with hopes that revenue would eventually follow. By the time reality set in, these companies lacked sustainable revenue streams, which led to mass bankruptcies as capital dried up. Today's leading AI firms like Microsoft, Google, and NVIDIA demonstrate robust revenue growth across multiple sectors. Microsoft's Azure cloud services and NVIDIA's near monopoly on AI chips illustrate how these companies have built stable, diversified income sources that help justify high valuations. Additionally, Microsoft's revenue in 2024 is expected to grow by around 20%, with cloud and AI services accounting for a significant portion. Analysts see this as a reason AI stocks may have more resilience than the pure hype-driven dot-com stocks, though concerns remain about overvaluation, particularly in smaller AI startups without solid revenue bases. Federal Reserve, inflation, and the bubble bursting. The Federal Reserve's response to inflation and speculative bubbles is as relevant today as it was during the dot-com era. In the late 90s, the Fed raised interest rates several times to curb an overheated economy, which helped trigger the dot-com bust by making borrowing more expensive and cooling investor enthusiasm. In 2024, Fed Chair Jerome Powell faces a similar balancing act. Inflation remains a concern, yet tech stocks continue to rally, especially in AI, prompting fears that easy money could lead to a bubble. Powell has signaled caution, suggesting a more gradual rate hike approach to avoid stifling growth, but any substantial cuts in rates could fuel further AI stock speculation. Economists warn that if rates are lowered prematurely, the market could experience what former Fed Chair Alan Greenspan dubbed irrational exuberance, further inflating AI stocks to potentially unsustainable levels. As AI investment continues to drive stock prices upward, the Fed's choices on inflation control could heavily influence whether today's tech boom becomes another bubble. Top tech survivors and busts. Then and now, among the dot-com casualties were companies like Pets.com, while Amazon and eBay emerged as major survivors. Today, we're likely to see a similar shakeout in the AI sector. Giants like Microsoft, Google, and NVIDIA are poised to dominate, while smaller speculative startups may not fare as well. Experts predict that 2024's AI bubble, if it bursts, will leave a smaller but stronger group of companies at the top, much like what happened after the dot-com crash. Internet, and the reality check. Are we smarter now? Comparisons between the dot-com bubble and today reveal that investors still fall for hype, though there are signs we've learned some restraint. In 2000, companies could go public with only an idea. Today's market demands a bit more proof. That said, AI stocks are pushing the limits, with investors captivated by AI's potential across sectors from healthcare to finance. Despite today's more stringent requirements, some analysts warn that too much of the current AI boom still relies on potential, a lesson that burned many in the early 2000s. Economic risks. Recession looms if the bubble pops. Just like the dot-com bubble, a burst of the AI hype could lead to broader economic problems. Following the dot-com collapse, the U.S. economy experienced a recession in 2001. Today, the rapid pace of AI stock growth has some economists on edge, fearing that a sharp drop could trigger layoffs and a slowdown, especially in tech-heavy regions like Silicon Valley. Current data show that a soft landing remains possible, but only if AI growth slows to more sustainable levels. Can we avoid another dot-com disaster? The dot-com bubble taught investors to be wary of hype without fundamentals. In 2024, while the AI sector may seem similar, today's tech companies have the advantage of robust revenue and proven business models. Nonetheless, some experts urge caution, as AI valuations are rising faster than earnings can justify. The future may be bright for AI, but smart investors are keeping one eye on the fundamentals and the other on the exits. Wow, what a ride through the highs and lows of the dot-com bubble, and how it's echoing in today's AI frenzy. History really does repeat itself, right? If you found this deep dive eye-opening, don't forget to smash that like button and hit that subscribe button and turn on notifications. Let's keep exploring the wild, unpredictable world of tech together. Thanks for watching, and see you in the next video.